Hello, everyone, and welcome to another episode of Canada's Real Deal. I'm your host, Anuj, and I'm a real estate broker in the Greater Toronto Area.
And my name's Aneeka Dogra. I'm a mortgage agent level 2. And today we have a very special guest, one of my favorite people in the industry, Robert DiPaolo, a business development manager from Manulife, as our special guest. Hi, Rob.
Hi, how are you?
Good. Why don't you tell us a little bit about yourself?
So I've been in the financial services for about 32 years. The first half of that I spent as an investment advisor with a major bank and with the largest independent firm in Canada. Then in the second half of my career, I moved to the liability side. So I worked for the largest bank in Canada, the largest non-bank lender, and then recently joined Manulife Bank.
Amazing. Yeah, so you have a lot of experience with different types of mortgages, how everything's changed.
Yeah, I guess as a financial advisor, the focus was always on assets, but it's only part of the equation. I think to really do proper financial planning, you have to look at both sides of the balance sheet. And I really like being on this side now and seeing, because for most people, paying the mortgage off is actually the most important part of building financial freedom. Once you pay your mortgage off, then you can start building wealth. And I think that's an important piece that's missing today for a lot of Canadians.
Yeah, that's so true. Canadians just love to keep themselves in debt and just take out the debt over and over and over again. But why don't we start talking about how mortgages work? So how do conventional mortgages work that Canadians typically take out?
So a traditional mortgage, known as an amortizing mortgage, just is simply a payment schedule. So everything is predetermined, the interest is set, the payments are set. And for most people, it's great because you can buy your house, you can pay for it over 25 or 30 years. If people really want to get aggressive, they can make extra payments instead of monthly. They can do bi-weekly payments, and they can get that down to about 17 years. So it really helps. With 5% down, you can get into home ownership. So that is great for most people. However, there are pitfalls to conventional mortgages.
Yeah. So what are some of the pitfalls that maybe Canadians aren't aware of with conventional mortgages? Because it's just the norm for most people, right? So
when in a traditional mortgage, let's say your amortization, your payment schedule is over 25 years, the first 7 to 10 years are mainly interest. It's always going to be a combination of principal and interest, but in those first 7 to 10 years, that's really all you're paying. Mm-hmm. And the problem with that is you can say, okay, I can pay this mortgage off in 17 years. If I do extra payments, everything is great. But the average Canadian refinances every 5 to 7 years. And what happens is they're either consolidating their debt or they're moving to another property. Mm-hmm. In both cases, they end up resetting. So they make all this progress and then they go right back to the starting. So they're really never paying their mortgage off. The average first-time home buyer in Canada is now 36 years old. And if that person never moves, if they never refinance, they're going to carry that mortgage until they're almost 60. So the question becomes, when do they start saving for retirement?
Yeah.
And it's almost become acceptable to carry a mortgage until you're 60. Yeah. And it shouldn't be.
Yeah, that's so true. I mean, I make all these videos all the time about mortgages or home ownership is about financial security for your future to prepare for retirement. But most people don't get there because they're just going to continue to take out money over and over and over and over again.
Yeah, most people focus on the rate with the mortgage. And that seems to be, if I get the best rate, it really means I want to save money. I think everyone has the same goal. They want to save money. They want to pay their mortgage off as fast as they can, but they don't know how to ask for that. They know how to ask for the best rate. And really a mortgage is 3 components. It's rate, it's principal reduction, and it's the time you're spending with that mortgage.
Right.
And the problem with just focusing on a rate is that it really doesn't give you the whole picture. The average Canadian will pay their mortgage twice. Mm-hmm. And that's not a great way to build wealth. If you're saying, I have a $500,000 mortgage, but I'm going to pay the lender back $1 million, that really doesn't work. So, and if rate was really the most important thing, we enjoyed some of the lowest rates in the 1990s for that decade, yet household debt has gone through the roof. Now, for every dollar a Canadian earns, they owe 3.
Yeah,
so if rate was the be-all, end-all, then the debt would actually be coming down, but it's going the opposite way.
Right. It's if you're not financially savvy to know how to make the most of your investment, then you're just going to be in this continuous kind of debt cycle, right? You're never actually going to get ahead. You're just going to be paying for shelter, but not actually building anything for your future.
Well, and that's it. A regular amortizing or traditional mortgage assumes that everything is going to stay the same in your life, but nothing stays the same. Life throws you curveballs, right?
Yeah.
People get sick, they lose jobs, they move to different houses. And that's why traditional mortgages may not work for everybody indefinitely. Maybe to start out, but not for an indefinite period of time. There are better ways to pay your mortgage off faster.
So why don't you give us an example of what's a better way to pay off your mortgage faster?
So this is not a new concept. This has been around. It started in Australia about 30 years ago. In fact, most mortgages in Australia are being done this way. Some people call it the Australian mortgage. It's called an offset mortgage or an all-in-one mortgage. It's simply combining your financing needs, your mortgage, with your bank account. And that's really all it is in its simplest terms. And by doing that, every time you deposit money into your bank account, which is also now your mortgage, 100% of that deposit goes towards principal.
Okay. So like you said earlier, for the first 10 years, most of the payment that we're making is just going towards your interest, right?
Correct.
And so you're not actually attacking your principal. You're not actually building equity in your home. But with this product, since you're putting everything into paying off your mortgage, a lot more is going towards attacking your principal, even if you compare it to like making accelerated payments or biweekly payments.
Yeah, it's different from a traditional mortgage because when you're making and people love accelerated payments, and you know what? People that are doing that, kudos to you because you are attacking the mortgage, trying to pay it off, and they tie it with their income, which is usually biweekly. But that's a set payment schedule that you have, and like you said, it's mostly interest for the first 7 to 10 years, then usually gets reset back to the beginning. Whereas this product, from day one, every deposit you make reduces your principal by 100%. So for example, I'm getting, between my partner and myself, we're bringing in $20,000 every month and we're spending $10,000 every month. Well, I'm reducing my principal by $10,000. Yeah. And what we do with this product is we do a sweep every night. So we calculate the balance every night. So when that money goes in, we calculate your balance on that lower amount. And the money just sits there and it waits for you to spend it. People are going to have their bills that they're going to have to pay. They're going to have to buy their groceries and do everything. But when you deposit money into a bank account, the bank doesn't let that money sit there. They're using that money. And I don't want to speak ill will of the banks. I mean, we're really fortunate in Canada because we have one of the best systems in the world, but the banks make enormous profits off of people's deposits. People get their money, it just sits in their bank account. They really don't make much on it, very little. So call it an interest-free loan that you're making to the bank.
Yeah.
The bank takes the money and they lend it out to you or they invest it and they make enormous profits.
Yeah.
Right? And so when you have this type of product now, you become your own banker because the money goes directly against your principal balance every single time you make a deposit. And it's not just your income. It could be anything.
Yeah.
You have a side hustle. You're bringing in money. You're selling things. You can put money in there. RSP returns. You receive an inheritance. Anything, any extra money. People love to have bank accounts that they don't use.
Yeah.
Right? They're just like the emergency bank account.
Yeah.
And the nice thing about that, and I get why people have to do that, because with a traditional mortgage, when you put the money in there, it's a one-way street.
Yeah.
You don't get it back.
Yeah.
But with this product, when you put $10,000 in, you can also take $10,000 back, just like a regular bank account.
Right.
So that flexibility, we're not asking people to pay any more money. It's just use your money in a different way to reduce your balance and not just let it sit in a bank account.
Yeah, absolutely. So just like you said, if you have an extra $10,000 coming every month, right, and you're putting it into this account, attacking your principal, just in 10 months, you could reduce your mortgage balance by $100,000, and the interest that you're paying on that is going to be going down as well, right? That's like a significant amount in a very short amount of time.
Yeah. So remember the three components: interest rate, and it's not that rate's not important. It is, but the principal reduction is important because would you rather pay interest on $200,000 or $100,000?
Yeah.
So the faster we can lower that principal amount, and because we do a calculation every day, you can deposit money every day if you want, just like you would in a bank account.
Yeah.
And it's funny how when you focus on your debt, it's funny how you really look to attack it.
Yeah.
And for a lot of people, they just look at their bank accounts and they go about life and they really don't think about their mortgage that much as long as they have money in their bank account.
Yeah.
But I think it's important to realize if you have a $500,000 mortgage and $20,000 in your bank account, you have debt of $480,000.
Yeah.
Right? And that's all we try to do with this mortgage is pay attention to it, because your financial success in life depends on paying this mortgage off faster.
100%. And I think Canadians make the mistake of always looking at the payment, right? And that's why they're getting caught up in the interest rate, because that's going to determine how much they're paying per month. And they're not actually understanding, well, what is that payment doing? Is it actually effective? Is it actually reducing anything and actually building me wealth?
Yeah, that's a really good point because again, we're so focused on rates, and it's not an apples to apples comparison when you take a traditional mortgage, compare it to a Manulife One, and yes, our rate is higher, so our rate would be, could be 2% higher, but it's not an apples to apples comparison because you want the effective rate.
Yeah.
And if you're paying it down faster, that rate is not really the rate that you're paying if I'm reducing my principal that much faster.
This might blow people's mind, but even if if your rate is higher, right, you're actually paying less interest overall in the amounts of like tens of thousands of dollars in a very short amount of time.
Yeah, it's the focus on interest charge, not interest rate.
Yeah.
Because the interest rate doesn't really tell you how long it's going to take you to pay that mortgage and how much you're going to pay in interest.
Yeah.
So Rob, is there an ideal candidate for this product if there is one?
I would say it's someone that is really, really, not only do they make good money, they have extra money at the end of the month, but they're really focused on paying the mortgage off, right? And so they make good money, but they don't spend a lot of money. They really have a goal of paying it off because you really want to know how long it's going to take to pay this mortgage. And the problem is again, when you have a traditional mortgage, it always gets reset. So it's really hard to pinpoint that goal. So the ideal client makes good money, but they don't spend a lot. They're focused on paying because they understand that this mortgage getting paid off is really, really important. So again, it could be anyone, whether they're salaried or whether they're self-employed. It's really someone that probably has a budget and has a goal to say, yes, I'm going to pay this off and then I'm going to start building wealth. A regular mortgage is really a product. This is really a strategy, right? I'm going to pay it off and then what am I going to do? Am I going to invest in the stock market? Am I going to buy more, investments? Am I going to buy more property? What will I do after I've paid this off? And that's really those people that are focused and have that goal. This product works really, really well for them.
Okay, so Rob, if I was to pitch this to a client, how does this benefit them in the long run? Like, how does this make them an investor, or how can they use this?
Like a business owner, like a realtor type, someone who's on a commission instead of a straight salary.
Oh yeah, like for me too, personally, yeah. But like if I have somebody who has a home and decides to go with this product, like how does this set them up in the future to maybe like invest somewhere else?
Okay, so I like to say that this product is really good for opportunities, emergencies, and income. It'll allow you to do all of those things without having to go back to the bank. Once you have this product, you really don't need anything else. So if you look at a business owner, someone who has like a realtor, for example, you make the bulk of your money probably in the spring and the summer months. Well, the nice thing about this product is you're not on a schedule. You can make payments whenever you want. So when you get those nice commission checks in the summer, you can reduce your principal by that much, right? And you reduce it really, really quickly with every time you're getting these checks. But then in the winter, when it slows down, you don't actually have to make a payment. Like there's not a traditional payment that you would get with a regular mortgage. You'll basically have an interest charge at the end of the month. And when it's slow and the income is not as high, we're not going to actually ask you for a payment. Interest is still accruing, but there's no actual payment that you have to make. And that gives you that flexibility to really attack it during those months. And then when it doesn't, you don't have to really worry about having that payment. Just the same as if you got sick, right? And you had a mortgage and you had a traditional mortgage, you have to make those payments. But with this, if you have enough equity in your home, there's no payment that we're going to ask for. So you do have that flexibility. And that was really helpful during COVID, right? We didn't have a lot of deferrals in our payments because people had that flexibility. So it's great that you have that, but you also have to be responsible, right? With it.
So like, let's say there's an emergency situation that somebody needed money. How would they like pull money out and what would happen in that situation?
Well, because it's a regular bank account, you can take money out whenever you want. 10,000 can go in, 10,000 can come out. So the furnace blows and you don't have any other funds available, you just write that check like you would and just pay for that repair and then away you go. So it does give you that flexibility, whereas most people, let's say maybe they don't have a lot of savings and then they'd have to go and cash something in that maybe they don't want to. So it does give you that flexibility for emergencies, right? And also opportunities as you pay it down. Again, you should be looking for the next steps in your life to build wealth. A lot of people like to buy properties, right?
Yeah.
And this allows you to do that because as you build equity in that HELOC, you can take that money and you can use it as a down payment on a rental property, right? You can track it separately, so you can write that interest off, but it allows you that room to accumulate wealth. When you have that equity in your home, it really should be put to use. Right? It's great to pay off your mortgage, but what are you going to do with that money after?
Yeah.
And home ownership seems to be a great way to go, and people have multiple properties and doing very, very well with that. So it does give you that opportunity, right? Fast forwarding to when you're almost ready to retire, we can talk about that as well. Because again, people that save money, they have RSPs, they have their CPP, they have their OAS, that's great. But if they have a house that's free and clear, you can put a Manulife One on it, and you could draw down on this money or use it whenever you need it as a supplement to your regular retirement income. So again, an emergency comes up and you're on a fixed, a set income, but something happens with your home, something happens with your car, you have the money available, so you don't necessarily have to take more from your investments, you can just take it from your home. Mm-hmm. You can also set up a structure where you're taking payments every month, similar to a reverse mortgage. Until you hit 65% loan to value, there's no payment that's required. So you do have that flexibility in saying, okay, I have this equity in my home just in case I need it.
So yeah, it's kind of like similar to like a reverse mortgage, but in this instance, it's a way for parents to also distribute their wealth to their kids so that they have a chance to buy a home in this economy, right? It's like kind of a way for kids to get into home ownership without having to force their parents to make extra payments to give them that down payment.
Yeah, absolutely. That line of credit is fully open. You can have up to 5 tracking sub-accounts. So if you want to gift money to your child and track it separately, you can do that and help them with a down payment. Absolutely, you can do that. So there's a lot of uses for this product. It really is not a straight mortgage. It's a strategy.
Yeah. So you're not just building wealth for yourself, but you're also building wealth for the next generation, like generational wealth.
Absolutely. If you can do that for your kids and be able to have and control it. I mean, most parents would like to be able to help their kids while they're alive, and this product allows you to do that. Right?
Yeah.
It really does. So it really just changes with your life. And there's so many uses for this product. It's just looking at your mortgage differently.
Yeah.
Right. And not saying, okay, I know there's traditional mortgages, they do work, but this just gives you that flexibility to deposit money whenever you want, pull money out whenever you want, and pay it down faster.
Yeah. And we always say this product is for the financially savvy client, but I think this product also makes you more financially savvy.
Yeah, there's a lot of information on, like you can look up the Australian mortgage, you can look up all-in-one mortgages, offset mortgages. There's a ton of information online. And I like that the Gen Zs and the millennials are so tech savvy and they can find all of this information. And really you have to do your own homework. Look at it and see, is this right for me? Because it's not for everybody.
Yeah.
If you don't trust yourself with credit, this would not be the product for you.
No, absolutely not. All right. Thanks, Rob, for coming on and giving us all that information and helping our audience build the wealth for the future. But if you guys have any more questions, feel free to reach out to me and I'd be happy to talk about the product in more detail. But stay tuned for future videos where I'll break down effective rate and compounding periods to make all of this make even more sense.
Thank you so much for listening. I know I learned a lot, but if you like this video, please remember to like, comment, and subscribe, and hit that notification bell.